Welcome to Wealth and Means, advice dressed up like hard work.
Thanks to our listeners in Canada, Norway, Singapore, Slovenia, and the USA. It's episode 36. Let's get into it.
This week's set stretches from the Strait of Hormuz to an underground detector in southern China. We've got a peace draft that landed 2 days ago and didn't make the headline. We've got a crystal thinner than a human hair that bends visible light more powerfully than anything in nature. A chip you've never heard of that nearly shut down European car production. And a soccer team showing up to the world's biggest tournament for the first time in 40 years. What you didn't see in the news has 11 stories this week, including India's hidden consumer revolution, a Gen Z nostalgia wave that's giving brand managers nightmares, a neutrino observatory that just beat 5 decades of global physics research, and the real second-order story behind the largest IPO in market history. Wake Up Ready has the macro calendar for a genuinely consequential week. A new Fed chair meeting markets for the first time, a fragile ceasefire with enormous oil implications, and retail data that tells you whether the consumer is still holding. After that, the knowledge bomb draws the real distinction between the dot-com bubble and the AI IPO cycle. The greater debate goes back to one of the more brilliantly accidental inventions in American political history. And Let's Invent Again visits the circuit that made every battery-powered device on Earth possible, including the one you're probably using right now to listen to this.
The thread running through all of it this week is simple. The consequential things are almost never the loudest. They're the things nobody was watching until they were.
Let's go.
Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee. A quick thank you to our sponsor, agentweekly.ai, chronicling the absurd, the ambitious, and the algorithmically challenged corners of the AI agent economy. 2 days ago, on June 12th, U.S. and Iranian negotiators agreed to the final text of a draft peace deal. If you blinked, you missed it. The announcement landed the same morning every feed was covering SpaceX's first trading day, and it got buried. The context matters here. Since late February, U.S. and Israeli strikes on Iran effectively closed the Strait of Hormuz. Shipping traffic through the strait has sat at roughly 5% of pre-conflict levels for 3 months. Brent crude has averaged $105 per barrel. 20% of the world's daily oil supply moves through that narrow body of water, and right now, almost none of it is. Pakistani mediators brokered the draft text after rounds of direct and indirect negotiations. The deal in principle covers U.S. sanctions, Iran's nuclear and ballistic missile program, and the crux, maritime access through the strait. Trump had publicly demanded unconditional surrender. What he got was a draft document, and the distance between those two things matters. Every day the Hormuz Strait stays at 5% of normal traffic. There's roughly $10 to $15 per barrel of risk premium baked into global oil prices. That shows up in your gas price, your shipping costs, your inflation print. A deal that restores even 30% of normal traffic would represent the single largest near-term deflationary event of 2026. The question isn't whether that's significant, it's whether draft text becomes signed agreement and when. The attention reason is specific. This dropped June 12th, the same day SpaceX debuted, the same day 3 other major stories broke. In the modern news environment, that kind of scheduling collision is where consequential things go to disappear.
Draft text is not a deal. It's an argument that agreed to take a break. Watch the Hormuz opening timeline. That's the sentence in the document that actually moves markets.
Here's a number worth sitting with. Japan's nuclear cooling pools are at 80% of total storage capacity. The world's largest nuclear power plant, Kashiwazaki Kariwa, just restarted. One of its pools will be completely full within 5 years. Japan has no viable permanent disposal site and no realistic timeline to build one. Japan runs on this contradiction. It shut down most of its nuclear capacity after Fukushima, then slowly restarted reactors as an oil crisis made the energy math impossible to avoid. Nuclear now looks like the answer to energy security. But nuclear produces spent fuel that remains dangerously radioactive for tens of thousands of years. And Japan, smaller than California and among the most tectonically active countries on Earth, hasn't found a single municipality willing to host a permanent underground repository. The recycling strategy that was supposed to solve this has hit a wall. The reactor designed to reprocess plutonium failed and was decommissioned. The backup plan, as of today, is store it longer. 17,000 tons of spent fuel sit in cooling pools across 17 plants. Choosing and building a permanent disposal site, the Ministry of Economy estimates, would take 100 years. Why does this matter beyond Japan? Because Japan's nuclear problem is every democracy's nuclear problem. France, the US, Sweden, South Korea, every country betting on nuclear as a climate solution is quietly accumulating spent fuel that has no permanent address. The nuclear renaissance conversation rarely includes a slide on where the waste goes at the end.
The real limiting reagent for the nuclear comeback isn't public opinion or permitting, it's storage math, and the math is catching up.
A UAE-based deep tech company published research this week that mapped a crystal so optically strange it may reshape what a pair of glasses looks like in a decade. The material is molybdenum oxychloride. A team from Expansio, working with researchers at the National University of Singapore and the University of Chemistry and Technology in Prague, found that this crystal creates what's called an epsilon near zero effect at 512 nanometers, visible green light. And the light-bending interaction it produces is the strongest ever measured in a natural material. The crystal behaves simultaneously like a reflective metal and transparent glass, depending on the wavelength hitting it. It's thousands of times thinner than a human hair. What this means practically: the paper has handed optical engineers the precise numbers they need to actually design with this material, not just observe it in a lab, but build with it. Current augmented reality glasses require thick, millimeter-scale optical stacks to manage light. This crystal could collapse that to microns. The bottleneck in wearable display technology has never been the software. It's always been the optics. Every major tech company working on AR headsets or smart lenses has been constrained by the physics of redirecting light efficiently in a small enough form factor to wear. A natural material that bends light this powerfully without a complex multi-layer structure isn't just a curiosity, it's potentially the piece the field has been waiting for. The attention gap is partly geographic. Expansio is based in the UAE. The partner universities are in Singapore and Prague. This isn't a Silicon Valley lab, and it didn't land in the usual distribution channels. The paper published in early June and got significant traction in optics and materials journals, and almost none anywhere else.
The most underrated barrier in every wearable hardware race has always been optics. Someone just handed the field a new tool and practically no one noticed.
On June 10, 2026, China's Jiangmen Underground Neutrino Observatory, JUNO, published its first physics result in Nature. Using 59 days of data, it achieved measurements of two key neutrino parameters that are 1.6 times more precise than the combined results of every prior experiment conducted over the past several decades. JUNO is a tank of 20,000 tons of liquid scintillator sitting 700 meters underground in southern China, built to catch neutrinos, subatomic particles so ghostly that 100 trillion of them pass through your body every second without touching a single atom. In its first 2 months of operation, it surpassed the precision of everything that came before it. The reason this matters for physics is specific. Neutrinos come in 3 types and oscillate between them as they travel. Their mass hierarchy is one of the last major unsolved questions in particle physics, and it may help explain why the universe contains more matter than antimatter, which is, in a very real sense, why anything exists at all. JUNO is now the experiment most likely to answer that question within this decade. The Nature paper dropped the same week as SpaceX's IPO, an Iran peace draft, and a World Cup opening. JUNO got buried. But there's a second-order note worth adding. JUNO sits in Guangdong province, built and operated by China. The country, currently in the middle of delicate geopolitical negotiations over nuclear architecture in the Middle East, just published a result that makes the world's most precise measurements of fundamental particle physics. Those two things aren't directly connected. They don't have to be. But the overlap of scientific ambition and geopolitical weight is worth naming, and almost no one is naming it.
Understanding the neutrino mass hierarchy tells you something about why matter won over antimatter at the start of the universe. China just got significantly closer to that answer.
Here's a number from FY26 that should have triggered a lot of strategy offsites: 66%. That's the share of new direct-to-consumer e-commerce orders in India that now come from Tier 2 and Tier 3 cities. Not Mumbai, not Delhi, not Bangalore. The Unicommerce analysis covered more than 400 million order items across 6,000 digitally native brands. Tier 2 and Tier 3 cities drove a 33% increase in order volumes and a 32% rise in gross merchandise value versus FY25. The World Economic Forum published a complementary analysis estimating that 93% of India's consumer spending growth between now and 2036 will come from outside the country's 5 largest metros. The WEF also estimates that 500 new consumer cities will emerge across India, with most of the growth happening in smaller urban clusters, not in the major hubs. In Chandigarh, a city most global brand strategists couldn't place on a map without assistance, international brand penetration now ranks higher than in several Tier 1 cities. 375 million non-metro urban Indians have simultaneously gotten reliable logistics, affordable smartphones, and rising real wages. That's not a demographic trend. That's a market that didn't exist in most spreadsheets 18 months ago. The business implication is direct. Any company that built its India strategy around the top 5 metros is already misallocating. The next 300 million consumer decisions in the world's fastest-growing major economy are being made by people in cities the boardroom hasn't heard of. The research infrastructure isn't there. The field teams aren't there. But the customers are.
The global consumer playbook is still built around 5 cities that no longer account for the majority of the growth. That's a lag that compounds fast.
Since December 2025, a trend has been building on TikTok and Instagram that has now crossed into something worth a full minute of attention. It's called 2026 is the new 2016, and it's been designated a breakout on Google Trends, meaning it's grown more than 5,000% in 6 months. What's actually happening? Millions of Gen Z users are voluntarily making their social media look like it's 2016. Grainy selfies, heavy filters, musically era audio, unedited footage, deliberately low production aesthetics. It started as ironic commentary and turned sincere faster than anyone expected. What they're nostalgic for isn't 2016 itself. Most of them weren't teenagers. They're nostalgic for a pre-AI internet. One where discovery felt organic, where small followings felt real, where imperfection signaled that a human was behind the content. The impulse is the same one driving vinyl record sales and the revival of disposable cameras. Authenticity has become a luxury. When everything is polished to algorithmic precision, deliberately imperfect content says, "A real person made this." That signal has value, and that value is growing. Here's the business implication most brands haven't processed. A lot of consumer marketing in 2025 and 2026 was built around AI-generated video and algorithmic content optimization. Gen Z just told you, through behavior, not stated preference, that they find it hollow. The generation that will dominate consumer spending for the next 4 decades doesn't want AI polished. It wants visibly human. That's not a trend to watch. That's a strategy correction.
When the generation most comfortable with technology chooses to escape it aesthetically, that's not nostalgia for the past. It's a signal about what the technology is doing to present human experience.
On June 3rd, Min Zin, a U.S. citizen and executive director of a Myanmar-focused think tank, was detained at Kunming Airport in China's Yunnan province. China confirmed the arrest on June 12th. He's being held on suspicion of espionage and endangering national security. He remains detained. Min Zin isn't a random traveler. He's a former participant in Myanmar's 1988 democracy movement, a political science graduate of UC Berkeley, and spent years running the Institute for Strategy and Policy focused on Myanmar's political landscape and the 2021 military coup. He was traveling through Yunnan, which shares a long border with Myanmar, when he was stopped. The timing makes the context notable. His arrest came 1 week after a Trump-Xi summit in Beijing that was framed as a de-escalation between the two powers, and it came directly ahead of a state visit to China by Myanmar's military chief. Min Zin's think tank has published work critical of China's relationship with Myanmar's junta. His detention could be a preemptive silencing before that visit, a bargaining chip in broader U.S.-China negotiations, or a simple demonstration that post-summit goodwill has terms. The broader implication is practical and chilling. Every arrest of an American academic in China resets the risk calculation for researchers working in sensitive geographies. If someone doing governance research on an authoritarian regime's neighboring territory is now an espionage target, the research ecosystem for understanding those regimes just got smaller. Less research means less visibility, which means less early warning. That has consequences for business, for policy, and for civil society. The arrest was confirmed on June 12th, the same day the Iran peace draft landed. It got buried under everything else.
The day a U.S. China summit ends with goodwill is often also the day you find out what the goodwill doesn't cover. This is what the terms look like.
A chip that costs roughly $5 brought European car production to a halt earlier this year. That chip was made by Nexperia, a Netherlands-based company owned by a Chinese parent called Wingtech, and it holds roughly 40% of the European automotive market for basic semiconductors, the transistors that control car windows, lighting systems, and sensors. Here's what happened. Dutch authorities seized Nexperia's headquarters in late 2025 as part of a dispute over strategic control of chip infrastructure. Beijing responded by halting exports of Nexperia chips manufactured in China. Honda halted production lines at multiple plants. Volkswagen sent emergency procurement teams. The chips themselves aren't advanced. They're not AI processors or cutting-edge logic. They're the unglamorous workhorse semiconductors that every modern car needs to function. Think of them like salt in a kitchen. No one considers them until they're gone. The partial resolution came when Beijing granted export exemptions, not because the underlying dispute was resolved, but because the production halt was damaging enough that everyone involved needed a pause. The exemptions are still in place, but the structural problem hasn't moved. Nexperia is still Chinese-owned. Dutch regulators still have claims on the company. U.S. sanctions exposure is still live. No European carmaker has qualified an alternative supplier that can meet volume. This matters for a reason that isn't obvious from the chip story alone. The Nexperia situation is a preview of how geopolitics and supply chain intersect in ways that can't be solved by diversification alone. When one company in one country owns 40% of a critical component market, and that country's relationship with a regulator changes, the $5 part becomes a production crisis for a $50,000 vehicle. That fragility hasn't been fixed. It's been paused.
An exemption is not a solution. It's a temporary agreement not to create a crisis right now. The underlying exposure is completely intact.
A team at the University of Birmingham published a paper in April that's gotten almost no mainstream coverage, and it might be the most economically significant clean energy result of the year. They developed a perovskite-based catalyst made from 4 relatively abundant, non-toxic elements, barium, niobium, calcium, and iron, that can split water into hydrogen at temperatures as low as 150 degrees Celsius. For context, current green hydrogen requires dedicated clean electricity. Blue hydrogen requires methane with carbon capture. Both are expensive. Both need infrastructure that doesn't exist at scale. This catalyst needs neither. It uses waste heat, the heat that steel plants, cement works, and chemical facilities already generate as a byproduct and currently vent into the atmosphere. The temperature reduction versus existing thermochemical approaches is 500 degrees Celsius. The preliminary economic analysis suggests the process could produce hydrogen at lower cost than either green or blue hydrogen alternatives. The university has filed a patent and is seeking development partners. The significance is specific to heavy industry. Steel, cement, and chemicals account for roughly 22% of global CO2 emissions. And they're the hardest sectors to decarbonize because they require high-temperature heat, not electricity. A hydrogen catalyst that runs on waste heat those plants already generate closes the loop without a new energy infrastructure build-out. With Brent crude averaging $105 per barrel and Hormuz at 5% capacity, the economic incentive to find cheap domestic hydrogen has never been higher. This result landed in April. It's still not in the mainstream conversation.
Converting industrial waste heat to hydrogen is the clean energy unlock heavy industry has been waiting for. The fact that it uses cheap, abundant materials makes the economics actually viable, not just theoretically elegant.
On Tuesday, June 16th, which is 2 days from now, Iraq plays Norway in Boston. It'll be Iraq's first World Cup match since 1986. 40 years. A country that's lived through 2 Gulf Wars, a U.S.-led invasion, a civil war, and the rise and fall of ISIS is sending a soccer team to Massachusetts. Iraq qualified in March by beating Bolivia 2-1 in the Intercontinental Playoff Final, with the winning goal from Ayman Hussein in the 53rd minute. They're in Group 1 alongside France, Senegal, and Norway. The odds of advancing from the group are long. That's not the story. The story is that they're here. There's a layer of geopolitical texture worth naming. Iraq's government is currently balancing its relationships between Washington and Tehran in the middle of an active ceasefire negotiation. The country sits in the zone of maximum diplomatic consequence right now, and at the same time, it's sending a soccer team to play in front of 40,000 people in New England. Soft power moments don't wait for hard power timelines. They don't ask permission, they just show up. The story has been covered in soccer publications, but almost entirely buried under coverage of Brazil, Argentina, England, and France. The narrative of a country showing up after 40 years in this particular geopolitical moment deserves 90 seconds before Tuesday's kickoff.
Sports is the one context where a country gets to be something other than a conflict zone. Tuesday is Iraq's 90 minutes for that. It matters more than the scoreline.
In case you missed it, SpaceX became the largest company by market cap in the world on its first day of trading. The valuation number is worth stating. A 19% first day gain from a $135 offer price to a $161 close on a $75 billion raise. But the story that matters most going forward isn't the price, it's the 30%. SpaceX earmarked 30% of its float for retail investors. That's 3 times the standard allocation for a mega-cap IPO. The company made shares available through Robinhood, Fidelity, Charles Schwab, SoFi, and Morgan Stanley's E-Trade with no minimum holding requirement. In the first 2 hours of trading, more than 1 million individual retail accounts had executed their first SPCX trade. What this does to the next wave of IPOs is worth thinking through carefully. OpenAI is targeting Q4 2026, Anthropic is looking at October. The combined anticipated raise for those two exceeds $160 billion, on top of the $75 billion SpaceX just absorbed. The question the IPO desk will be asking next week isn't, did SpaceX work? It's, what do a million retail investors do with a 19% first-day gain, and what does that behavior tell us about appetite for what comes next? A retail holder who bought SPCX at $135 and closed at $161 on day one is now making a decision. Hold a company at a $2 trillion valuation that's already priced in multiple years of growth, or sell and wait for OpenAI? That decision made at scale across 1 million accounts is the leading indicator for how the next wave of tech IPOs gets priced. The story isn't about space, it's about retail patience. The second order read, investors will pay for frontier science, but only with limits. Science fiction at market price is acceptable. Science fiction at any price is not.
30% retail allocation isn't charity. It's a distribution strategy. And now 1 million accounts have to decide what to do in week 2. That behavior is the data point worth watching.
3 patterns emerged across this set, and they're worth naming before we move on. The first, energy has become geopolitics. The Hormuz draft, Japan's nuclear waste crisis, the perovskite hydrogen breakthrough, crude at $105. The energy story isn't just an inflation story. It's a foreign policy story priced into everything. The second, the attention gap keeps pointing in the same direction. Iraq, after 40 years, India's Tier 2 consumers, the Juno neutrino result. The most consequential things this week were in the places no one was looking, and coverage consistently went somewhere else. And the third, supply chain fragility has become the new form of geopolitical leverage. Nexperia, Min Zin's arrest, the Hormuz shipping count, control of critical flows, whether chips or academic access or oil lanes, is how states exercise power without declaring it. Now let's wake up ready. The coming week has a rare combination. A new central bank chair meeting markets for the first time, a Middle East peace draft in active negotiation, key consumer data, housing construction numbers, and the digestion of the largest IPO in market history. Let's go 3 levels deep on each. The Federal Reserve meets Monday and Tuesday, June 16th and 17th, and this is Kevin Warsh's first meeting as chair. He was sworn in May 22nd. The rate decision itself is locked in. The federal funds rate stays at 3.50 to 3.75%, and markets are pricing less than a 10% chance of any cut at all in 2026. That's not the event. What to watch specifically is whether Warsh removes or modifies the phrase ongoing progress toward our 2% goal from the official statement. That phrase has been the anchor for market expectations of eventual cuts. If it disappears, the easing narrative is formally over. Also watch the updated dot plot and whether any governors dissent from the hold. Waller and Cook have been more dovish, and dissent from either signals a genuine internal split under the new chair. What's already priced? Virtually nothing. Markets have priced out cuts for the full year. The second-order consequence of a firmly hawkish Warsh tone, The dollar strengthens, emerging market currencies sell off. The peso, rupee, and real are most exposed, and mortgage rates, currently at 6.5%, could add another 15 to 25 basis points in the following 2 weeks. That hits housing directly, at a moment when Lennar just guided down.
Warsh's communication style was always the wild card. His first press conference is the moment markets find out whether the regime change is real or just rhetorical.
Tuesday morning also brings the May retail sales advance report at 8:30 Eastern. The retail monitor already showed monthly growth of 0.42% month over month for May. But the number to watch in the advance report isn't the headline, it's the control group, which strips out food, energy, auto dealers, and building materials. That's the Bureau of Economic Analysis's proxy for core consumer spending in the GDP calculation. If the control group comes in below 0.2% month over month, it signals consumer resilience cracking before the higher for longer message from a new Fed chair has even had time to land. What's priced? Markets expect moderate confirmation of the existing trend. Second order, if the control group misses, watch consumer discretionary small caps, specifically XRT, not XLY, because that's where the leverage to actual household spending lives, and it reprices faster than large caps.
The control group in retail sales is the number inside the number. That's the one worth finding before the headline hits.
Wednesday morning brings housing starts and building permits for May. The setup is obvious. Lennar just reported Q2 earnings, showing new orders fell 4% year over year. CEO Stuart Miller cited persistently elevated mortgage rates, constrained affordability, and geopolitical uncertainty. Full-year guidance came down. The specific signal Wednesday is single-family permits, not total starts. Below 900,000 annualized confirms the trend Lennar's guidance anticipated. Above 950,000 suggests the builder's own outlook was too conservative and the sector reprices upward. What's already priced? Markets have essentially built in a housing pause, not a collapse. Consensus expects softness. Second-order consequence if the miss is real. Lumber futures decline, the homebuilder ETF XHB leads equity downside, and watch regional bank earnings later in Q2. Those banks carry construction loan exposure, and a permits miss tells you something about their collateral quality.
Housing is where monetary policy becomes personal for most Americans. The permits number Wednesday translates the Fed's rate path into frames and foundation.
The U.S.-Iran draft peace deal is the wild card event of the week because it doesn't have a scheduled date. The draft text was agreed June 12th. Ratification or failure could happen any day through the end of the month, and markets aren't positioned for either direction. What specifically to watch, whether the deal language includes a concrete timeline for Hormuz reopening, and what percentage of pre-conflict traffic is targeted in Phase 1. Any agreement restoring even 30% of normal Hormuz capacity would drop Brent crude by $10 to $15 per barrel immediately, based on where the geopolitical premium currently sits. What's already priced? The crude market assumes the Strait stays near closed. $105 is a fully disrupted Strait price. Second order. If the deal advances with a reopening timeline, the rotation is significant. Airlines running on hedges that expire in Q3 are the most direct beneficiary of lower oil. Japanese and South Korean manufacturers get their export logistics back. And the May CPI print, 4.2% headline, driven largely by a 23.5% year-over-year energy surge, starts to decompress. That's the one scenario where Warsh gets room to pivot later in the year while letting inflation take the credit. And the post-IPO market this week runs on one question. What does SPCX do in week 2? SpaceX closed Friday at $161, a 19% gain from its $135 offer. 1 million retail accounts are sitting on that gain right now. Watch specifically whether SPCX holds above its 161 close or fades below the 145 level by Friday. IPOs that pop strongly on day 1 frequently give back gains in week 2 as momentum traders exit. If retail is holding and SPCX stays elevated, OpenAI and Anthropic will have evidence that absorption capacity for this IPO wave is real, and their Q4 timelines may move forward. If SPCX fades below $140 by Friday, watch for Anthropic to quietly push back its listing. What's priced? The market assumes a healthy pipeline of large-scale tech IPOs, and combined OpenAI Anthropic raise expectations above $160 billion. Second order if SPCX struggles. That assumption absorbs a credibility hit, and late-stage private valuations across the board reprice lower as the window is open narrative reverses.
And that is how you wake up ready. Here's the knowledge bomb. The dot-com bubble and the AI IPO cycle rhyme. but they are not the same song. In 1999 and 2000, the U.S. IPO market was not hot. It was radioactive. We had roughly 856 operating company IPOs in 2 years. About three-quarters were tech stocks, and nearly 8 out of 10 had negative earnings before going public. That was the classic dot-com profile. No profits, huge first-day pops, a business model described mostly in verbs, and a logo that looked like it had been designed during a Red Bull emergency. The official currency was not dollars, it was eyeballs. Eyeballs, clicks, page views, community, and the phrase first mover advantage, which did more damage to American capital formation than several small wars. But here's where the popular memory gets a little too simple. The dot-com IPO class did not immediately become a mass grave. 5 years later, a meaningful chunk had failed, but an even bigger chunk had been acquired, merged, taken private, absorbed, or quietly escorted out of the public markets with a blanket over its head. So the real story was not everything went bankrupt. The real story was everything got repriced. Some companies died, some were acquired, some became the foundation of the modern internet. But many investors learned the hardest lesson in markets. You can be right about the future and still lose money on the stock. The internet was real. The crash was real too. Now compare that to the 2024 to 2026 IPO environment. This is not the same flood. The market is not shoving hundreds and hundreds of barely formed public companies through the window like it's 1999 again. The newer IPO market is narrower, later stage, and more selective. In 2024 and 2025 combined, the cleaner operating company count was about 162 IPOs, not 856 in 2 years. So no, we're not in a perfect replay of the dot-com IPO mania. But we are still seeing something familiar. A lot of these companies have revenue. Some have enormous revenue. The problem is that revenue is not the same thing as durable earnings. That is the difference between the dot-com bubble and the AI cycle. The dot-com bubble was about belief before business models. The AI IPO boom is about revenue before earnings. And that is better, but it is not automatically safe. Take CoreWeave. This is not a please admire our website traffic company. CoreWeave has real demand, real customers, and massive revenue growth. It is selling something the market urgently wants, AI compute. But it is also a capital expenditure monster. Data centers, GPUs, networking, power, cooling, debt, leases. The whole thing looks less like a software company and more like a railroad made out of NVIDIA chips. So the product sells. The question is whether the balance sheet survives the appetite. Then there's SpaceX. Again, this is not pets.com in a flight suit. SpaceX has launches, Starlink, defense work, government contracts, commercial demand, and one of the most impressive engineering machines in modern business. It is very real, but real does not mean cheap. If investors value SpaceX like every future version of the company has already arrived, global broadband monopoly, space logistics platform, defense backbone, Mars optionality, and whatever else gets whispered into the valuation cauldron, then the risk is not that SpaceX is fake. The risk is that the price already believes too much. That is not catching a falling knife. That is catching a shooting star. And then we get to OpenAI and Anthropic, which may be the cleanest expression of the entire cycle. These are not empty dot-com shells. They have usage. They have customers. They have enterprise demand. They have consumer demand. They have cultural dominance. They have the thing every startup wants. People actually use the product. But the hard question is not, is AI useful? Of course it is useful. The hard question is, can this usage be served profitably at scale? Because every prompt has a cost. Every answer touches compute. Every model upgrade demands chips, power, talent, data, infrastructure, and capital. This is not the old software fantasy where you build it once and copy it infinitely at near zero marginal cost. AI has a marginal cost problem wearing a magic costume. And that is what makes this cycle so interesting. The dot-com companies needed users to become customers. The AI companies already have customers, but they need customers to become margins. That is a very different problem. The old bubble burned cash on Super Bowl ads. The new bubble burns cash on GPUs. The old question was, will anyone use this website? The new question is, can we afford for everyone to use this model? That's why the AI IPO cycle is more mature and more dangerous at the same time. More mature because the revenue is real. More dangerous because the valuations are pricing in not just success, but dominance, not just adoption, but margin expansion, not just growth, but infrastructure control, not just demand, but no brutal price war, not just intelligence, but economics. And economics is usually where the poetry gets mugged. So here is the lesson from 1999 that investors should tattoo somewhere tasteful. Being right about the technology is not the same as being right about the investment. The internet was real. Plenty of internet stocks were terrible investments. AI is real. Space is real. Cloud infrastructure is real. Agentic software is real. But if you pay tomorrow's monopoly price for today's capital-intensive growth company, the future can arrive exactly on schedule, and your return can still not. The innovation can work, and the investor can lose. And that's the knowledge bomb.
Humor me for a second. We need to upgrade the old jokes. Not cancel them, not retire them, upgrade them. Because a lot of classic jokes are not really jokes anymore. They're tiny museums, cultural fossils from a time when people answered doors, read newspapers, used landlines, mailed checks, and believed chickens could cross roads without triggering a neighborhood incident. Take the most famous joke in civilization. Why did the chicken cross the road? To get to the other side. Beautiful, elegant, completely outdated. First of all, the chicken is not just crossing the road anymore. The chicken is being geofenced. There's a Ring camera, 2 Teslas in self-driving mode, a school zone speed camera, a drone delivery corridor, and a next door post titled Loose Poultry, Anyone Else Concerned. So the modern version is, why did the chicken cross the road? Because the algorithm recommended a higher engagement pasture on the other side. That chicken is not crossing for philosophical reasons. That chicken is crossing because someone introduced dynamic egg pricing. Then there's the knock-knock joke. Knock, knock. Who's there? Nobody knows anymore. Nobody opens the door. The modern knock-knock joke is, knock, knock. Motion detected at your front door. Who's there? Person. Person who? Person has been detected at your front door. That's where we are now. We took community-based call-and-response comedy and replaced it with a surveillance notification written by a robot that doesn't want legal liability. The whole premise of the old knock-knock joke is insane now. Someone knocks, you say, who's there? They give you a name, and then you voluntarily continue the conversation. That is not modern behavior. Modern behavior is staring at your doorbell camera from your phone, whispering, "Who is that?" and pretending you're not home while your dog provides sworn testimony. Then there's, what's black and white and red all over? A newspaper. That joke now requires a docent. A newspaper was this thing where every morning a person threw compressed information at your house and then you paid to recycle it. Today the answer is, what's black and white and red all over? A screenshot of a paywalled article being shared by someone who did not read it. Comedy depends on common reality, and common reality now has 3 pricing tiers. So yes, we need a national joke upgrade program. Why did the chicken cross the road? To escape a non-compete clause. Knock, knock. Please verify you are not a bot. How many people does it take to change a light bulb? Depends. Is the bulb interoperable? Is your refrigerator running? Yes, but only after a mandatory software update. A man walks into a bar, then checks the reviews, the menu photos, the parking, the cocktail prices, the vibe, the cancellation policy, and whether the bar has been accused of anything weird on TikTok. Then he stays home. That's the modern punchline. We didn't stop telling jokes. We just moved the setup into software, the punchline into logistics, and the laugh track into a group chat.
There are debates that stop your scroll, and there are debates that clear the dinner table. It's time for the greater debate. Tonight's greater debate is about one of the great accidental inventions in American political history, the federal income tax. And I know, income tax debate sounds like a phrase specifically designed to make a man check his phone during his own podcast. But stay with me, because the origin of the U.S. income tax is not really a story about forms, deductions, or your accountant saying we should probably extend. It is a story about who pays for the country. Before America had a modern income tax, the federal government largely funded itself through tariffs, customs duties, excise taxes, and the occasional sale of public land. That meant the cost of government was often hidden inside the price of goods. You didn't get a federal tax bill, you got a more expensive coat. You didn't see Washington taking money out of your paycheck. You saw higher prices on imported wool, sugar, coffee, tools, and manufactured goods. And that created the debate. On one side, we have William Jennings Bryan, Prairie Thunder, populist hero, defender of farmers, workers, and the idea that wealth should not be allowed to hide behind the cash register. On the other side, we have Nelson W. Aldrich, Rhode Island senator, old guard Republican, high priest of the protective tariff, and the kind of man who looked at a customs schedule the way poets look at sunsets. So let's stage the debate. The question on the floor: should America keep funding the federal government through tariffs on consumption, or should it introduce an income tax that reaches accumulated wealth directly? Aldrich opens, and Aldrich says, look, the tariff is not some crude political trick. The tariff is the American system. It raises money at the border. It protects domestic manufacturers. It keeps American industry from being crushed by foreign competition. It funds the government without creating a national army of revenue agents knocking on private doors asking what every citizen earned. To Aldrich, the tariff is elegant. Collect the tax at the ports, protect the factory, pay the bills, move on. No annual financial strip search, no federal interrogation, no turning the citizen into a spreadsheet. That is the conservative case. And honestly, it is not nothing. The tariff was productive. It raised enormous revenue. After the Civil War income tax expired in 1872, the United States went back to a tariff-based revenue system, and that system generated major federal surpluses for decades. The problem was not that the tariff failed to fund the government. The problem was that it funded the government in a way that made ordinary people feel like the invoice had been baked into their breakfast. Because tariffs do not announce themselves, they arrive as higher prices. Aldrich says this is protection. Bryan says, no, Senator, this is camouflage. Now Bryan rises, and Bryan's argument is not subtle. He says, if the federal government protects property, enforces contracts, supports commerce, builds the legal order, and keeps the whole machine running, then why should the burden fall mainly on consumption? Why should the farmer pay through the price of manufactured goods? Why should the worker pay through the cost of necessities? Why should the ordinary household fund the nation every time it buys what it needs, while accumulated wealth gets to stand in the balcony and applaud fiscal responsibility? That is Bryan's point. The tariff taxes what people must buy. The income tax taxes what people are able to earn. That is the moral distinction. A tariff says pay when you consume. An income tax says pay according to capacity. And Bryan is not asking for some confiscatory revolution. The 1894 income tax was a 2% tax with a high exemption. In other words, for most Americans, it wasn't even coming for them. But it was coming for the people who had income large enough to make the argument interesting. Bryan's side says this is justice. Aldrich's side says this is class warfare. And here is where the debate gets beautifully American, because both sides accuse the other side of class warfare. Bryan says making the masses pay through tariffs while wealth escapes is class warfare from the top down. Aldrich says singling out high earners for special taxation is class warfare from the bottom up, which means, as usual, the real American tradition is not avoiding class warfare. It is accusing the other guy of starting it. Aldrich comes back with the argument that still lives today. An income tax is invasive. It requires disclosure. It requires records. It requires the federal government to know things about your private life. The tariff may be imperfect, he says, but at least it does not require Washington to inspect your income. And this is the strongest anti-income tax argument. Because once the government can tax income, it must define income. Once it defines income, it must measure income. Once it measures income, it must demand records. Once it demands records, congratulations. You have created a relationship between citizen and state that is much more intimate than a tariff receipt at the Port of New York. Bryan's answer is yes, but hidden taxation is not liberty. A tax you cannot see is not automatically freer than a tax you can see. If government is going to cost money, Bryan's side says, then the burden should be visible, direct, and fairly distributed. Aldrich says visibility is exactly the problem. Bryan says invisibility is exactly the scam. That is the core of the whole debate. Then the Supreme Court walks into the room, In 1895, in Pollock v. Farmers Loan and Trust Company, the court strikes down the 1894 income tax as unconstitutional in its treatment of income from property, because it was considered a direct tax that hadn't been apportioned among the states. Apportionment sounds boring because it is, but it matters. Apportionment meant the tax had to be allocated among states according to population, which makes a practical national income tax nearly impossible. It's like saying you may have a fire department, provided every bucket of water is assigned according to census math. So Aldrich smiles. The court has done what the old guard wanted. The income tax has hit a constitutional wall. Bryan rejects this notion, because to Bryan this means wealth has not merely won politically, it has found constitutional shelter. And now the debate changes. It is no longer just, is an income tax fair? It becomes, does Congress even have the power to impose one? Bryan's answer, then change the Constitution. Aldrich's answer, wonderful idea. Amendments are hard. Please enjoy losing slowly. Now we jump to 1909. The Republican Party controls the federal government, but it's split. The old guard wants high protective tariffs. Progressive and insurgent Republicans want reform. Democrats want tariff reduction and income taxation. President William Howard Taft is trying to keep the party together, which is what politicians say right before the furniture starts moving. Aldrich is managing the Senate side, and insurgents are pushing an income tax amendment. Aldrich doesn't want it. Taft doesn't want to lose control of the issue, so they reach for what looks like a clever move. They support a constitutional amendment authorizing an income tax, but not necessarily because they want it to pass. The strategy is send the income tax into the amendment process, where it will probably die. It needs 2/3 support in Congress and ratification by 3/4 of the states. That is not a hallway. That is a political obstacle course with snakes. So the establishment theory is simple. Give the income tax people a constitutional process instead of an actual income tax. It is the Washington version of, we formed a committee to study your emergency. Aldrich thinks he is defusing the bomb. Bryan's side looks at the bomb and says, thank you for installing a fuse. Because the amendment does not die. It passes Congress. It goes to the states. The states ratify it. And in 1913, the 16th Amendment becomes part of the Constitution. Then Congress passes the Revenue Act of 1913, and the modern federal income tax is born. Aldrich tried to send the income tax into procedural exile. Instead, he helped give it a constitutional passport. So if we compress the whole debate into one exchange, it sounds like this. Aldrich says, the tariff built America. It protects industry, funds government, and avoids federal intrusion into private income. Bryan says, the tariff taxes the many through consumption while protecting the few through policy. If wealth benefits from government, wealth should help pay for government. Aldrich says, you're punishing success. Bryan says, you are hiding taxation inside necessity. Aldrich says, you are inviting federal overreach. Bryan says, you are preserving a system where the poor pay invisibly and the rich complain visibly. Aldrich says, the Constitution does not permit your scheme. Bryan says, then the Constitution needs to say what justice requires. And then history, with its usual sense of humor, hands the final assist to the people trying to stop the thing. The origin of the income tax is usually taught like a civics footnote. But that misses the drama. The real debate was about whether government should be funded through prices or through income, through the things people buy or the money people make, through invisible consumption taxes or visible ability to pay taxes. That is why the income tax became so powerful. It did not just create a new revenue source, it created a new political mirror. Every year, the country has to look at itself and ask, who has income? Who has wealth? Who carries the burden? Who gets protected? And who gets the bill? The income tax did not end the fairness debate, it institutionalized it. And that is the final irony. The income tax was not introduced because America suddenly agreed on fairness. It was introduced because America could not agree on fairness and needed a machine to fight about it every year. Bryan was asking, who should carry the cost of government? Aldrich was asking, how much can the federal government know about me? They weren't answering the same question. which is why neither of them could win and why the debate never ended. The tax that was supposed to lose became the tax that funds the argument. And that is the greater debate.
Let's invent again. In 1962, Frank Wanlass joined a company called Fairchild Semiconductor in Mountain View, California. He'd come from the University of Utah, and he had a problem he couldn't stop thinking about. The problem was power, not the political kind, the electrical kind. The dominant transistor technology of the early 1960s was the bipolar circuit. Fast, capable, genuinely impressive for the era. But bipolar circuits drew current continuously, even when they weren't switching, even when they were just sitting there waiting for something to do. For computers the size of refrigerators plugged into the wall, this was tolerable. For anything that needed to run on a battery, it was a deal breaker. You'd drain your power source long before you'd gotten any useful work done. Wanlass had an idea. He wanted to pair two different types of field effect transistors, a P channel and an N channel, in a complementary arrangement. The insight was elegant. In a complementary pair, significant current flows only during the brief moment of switching from one state to another. Between switches, the circuit is effectively dormant, passive, spending almost nothing. The problem was that the N-channel transistor he needed for his design didn't exist yet, so he built it. He worked out the physics, developed the fabrication approach, and built the component his own circuit required. In 1963, Wanlass demonstrated his complementary metal oxide semiconductor circuit, what we now call CMOS, and the results stunned the room. In standby mode, the CMOS circuit drew 6 orders of magnitude less power than the best bipolar circuits of the day. 6 orders of magnitude. That's 1,000,000 times less current when the circuit isn't actively switching. He published. Fairchild filed the patents. And then for nearly a decade, almost nothing happened. Because CMOS was difficult to manufacture reliably at scale, and the semiconductor industry was focused on speed, not efficiency. Speed sold computers. Speed won government contracts. Nobody was pricing the electricity bill into the silicon roadmap. The unexpected consequence came when someone finally asked a different question. What if the device doesn't have a wall outlet? The digital watch was the first mass-market answer. A watch needs to run for a year on a battery the size of a fingernail. Bipolar couldn't do it, CMOS could. So the digital watch became the first commercial product built around Wanlass's circuit, and that unlocked the chain. Then came pocket calculators, then portable radios, then pagers, then cordless phones, then the one that changed everything, the mobile phone. Because once you could build a chip that ran efficiently on a small battery, you could put that chip anywhere. And a chip that can go anywhere is a chip that anyone can own, in any city, in any country, at any income level. Think about what's in today's episode. 375 million non-metro urban Indians buying products through smartphones, possible because of CMOS, the chip in every Nexperia transistor that controls your car windows. CMOS architecture. The readout electronics in Juno's 20,000-ton neutrino detector. CMOS. Every Starlink satellite in the SpaceX constellation that started trading yesterday. CMOS throughout. Frank Wanlass didn't set out to connect the world. He set out to solve the standby power problem. He solved it so completely that the solution became invisible, embedded in every device so thoroughly that we stopped noticing it was there. He was inducted into the National Inventors Hall of Fame in 2009. He died in September 2010. His circuit is running right now, in the device you're probably using to listen to this. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the arc. From a draft piece deal in the shadow of a closed strait to a woodshed-era insight that runs every device in the modern world. From the largest IPO in history landing in 1 million retail accounts to an underground tank of liquid in southern China measuring the lightest particles in the universe. The pattern was simple. Look smaller, always, because first principles are rarely flashy.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, agentweekly.ai.
Till next time, stay curious.
Stay kind.
And keep compounding.